I was talking with some friends about the role of population growth within unemployment and inflation, and we had a little debate, so I'd love to hear what you have to say on that.
Sure. So all of the statistics I showed you are a percentage of the population, which means we're adjusting for the growing population. If I showed you raw numbers of the people who have jobs or the people who don't have jobs, those would be rising all the time because the US population is growing. Right? So we have to adjust for population growth to be able to make any sense of it. Right? Otherwise, everything would keep going up. Now, beyond that, population growth can be important for the health of the labor market. And the most important way is through the demand for housing. If the population is growing, we need more houses than we already have in general. Right? That creates demand for workers to build those houses, and so that creates jobs. So population growth in and of itself can be a source of economic growth and of jobs and of strength for the economy. Right? But the most important thing is that we have to make sure that we adjust all of these statistics for population growth, because otherwise they would look really crazy.
So I have a question for you. I was wondering why wages have remained so sticky with the labor force participation as low as it's been.
Sure, that's a fantastic question, right? So wages in the Great Recession, the unemployment rate shot up, the job market was really bad, and you might have thought that what employers would do is they'd say to their current workers, well, you're lucky to have a job. All these people out there, they want your job, so I'm going to pay you a lot less. And you're going to have to live with that because otherwise you'd be out of a job and you'd be looking and you wouldn't have a job to find. And of course, that's not what happened, right? Wage growth has been slow, but we didn't see massive economy-wide cuts in wages when unemployment was really high. So there are a number of theories of why this happens. One theory is that it would create very bad morale at a job, at a company, if employers actually came in and cut people's pay. And if you create bad morale, people won't be productive. And so that's not the best choice for the employer. So instead, wages might be what we call downwardly sticky, which means employers are willing to raise them when that's the right thing to do, but it's hard to lower them. Right? And if that's the case, what happens is that employers will wait until wages have come back up, and they won't give people raises for perhaps a very long time, but they won't actually cut pay. Instead, what they'll have to do is lay people off because the wages are too high to justify employing all those people. So that's one theory of what might happen. Another theory of what happens in recessions is that employers say, okay, we don't want to cut wages, that's going to hurt people's feelings, but we do need to get enough out of people to justify these high wages that we're paying them, so we're going to make them work very hard. Right? We're going to insist that their productivity goes up. So, and economists have actually done studies of this and have found it in situations where it's very easy to measure workers' productivity. For instance, in a call center where you can measure how many phone calls someone answers per hour, that workers in places where the local unemployment rate is high tend to have higher productivity than workers in places where the local unemployment rate is low. Right? And one theory is the employers are saying, well, I'm not going to cut your wage, but I want you to do more work for me in each hour, which is the same thing, really. Right? So that's another explanation. A third is when the economy is bad, employers lay people off, and they've got a choice of who to lay off. Right? They could just lay people off at random, but that doesn't seem like the smartest thing to do if you're an employer. So what they probably do is lay off the workers who are least productive in their current jobs. Right? That doesn't necessarily mean that those people are least productive in any job, but they're just not the best fit for the job that they're currently in, and that's who the employer might choose to lay off. If they do that, the remaining people are the ones who are more productive. Right? And again, the employer has managed to raise productivity while keeping the wage the same. So those are some theories of why wages might not fall in a recession.
On your labor force working part-time for economic reasons, how do you take into account somebody that might be working 60 to 70 hours a week at 3 different part-time jobs because they can't get a full-time job?
Right, so they would be counted in that.
As like one person? Or
right, so they would be saying that in their main job, it's a part-time job because they can't get as many hours as they want.
Okay.
Well, I have a little bit of a long-winded question, so bear with me.
So I should apologize. The lights are blinding me, and I can't necessarily see where everyone is. So you should wave. Okay, there you are.
All right, so when you look at the labor force participation for men in the U.S., it's just a long-term decline in that, starting as far back as the data you can access from 1948 to today. And I was wondering if you had any comments on that. And the big change in labor force participation that I can find in the data is that in the cohort 16 to 19-year-old has been the really big drop-off in labor force participation since the recession.
Yeah, those are great points about the data and great questions. So if you look at the labor force participation rate separately for men and women, the pictures are very different. For women, the labor force participation rate was rising for a very long time, and then basically leveled off around 10, 15 years ago, and then very recently has started to drop a bit. For men, it's been dropping gradually for as far back as the data go. So why might it be dropping for men? There's a couple factors that matter, but to be honest, I'm not sure that we know how much these factors matter and what else might be going on. One is people have been getting more education. In order to get education, you've obviously got to be out of the workforce, right? And so that may be pushing down labor force participation as people choose to instead go to school. So that's one factor. Another factor is women's labor force participation going up, right? So imagine a couple, a man and a woman, deciding what to do. In the 40s, the common decision was that the man would work, and quite often, the woman in that couple would not be working. More recently, as more women have been in the workforce, some men have been dropping out, because you might still make the decision, we want only one person in this couple to work. But more recently, it might be that the woman is working and the man is not working. So that change could also be pulling down men's labor force participation. But there are other things going on as well. For instance, the rate of people having disabilities is going way up, right? And when someone's got a disability, they're out of the workforce, right? We don't fully understand why that's going up. So there are a lot of moving parts there. Your other question was about labor force participation in the recession among 16 to 19-year-olds, right? And it's been quite low. This is part of what I mentioned about young people's labor force participation in general, not just 16 to 19-year-olds, but even people in their 20s, is very low compared with previous cohorts when they were those ages, right? So what might be happening? There's a few factors. One is that when the economy is bad, that's a good time to get an education instead, right? So it's likely that more people have been getting education during these years when the economy has been weak than would have if the economy had been stronger, right? And that would push down labor force participation. Another factor is just that the economy is weak. And so if the economy is weak, that's a good time to do things besides trying to work, right? If you're going to try to search for a job, you want to do that if there are jobs to be found. And unemployment rates for teenagers have been spectacularly high in recent years, right? So if you're looking at that as a teenager, you may say, why even look? I'm not going to find something. Let me choose to go to school, or let me just hang out with my friends, or let me do things around the house that are helpful to my family but are not paid jobs, right? Those kinds of choices all make more sense when the economy is weak than when it is strong. And so the fact that the economy has been weak may be driving down labor force participation. And if the economy were stronger, more of those kids and more people in general might look for work and then find it.
I was wondering if you could talk about some of the non-economic factors contributing, like shifts in various industries or geographies or urban migration.
Fantastic. That's also a wonderful question. Right. So for a worker to find a job, they don't just have to locate the place that has the job. They have to be qualified for that job. They have to have the skills that job needs, and of course they've got to live somewhere near where that job is so they can do it. Right. And so there's been a lot of debate over whether in the recession workers and jobs have been mismatched. Maybe the workers are not in the places where there are jobs, or maybe the workers don't have the skills that the jobs need. And economists, including me and some of my co-authors, have spent a bunch of time trying to figure out whether that's really happened. So one thing that people have looked into is whether workers are not in the places where there are jobs, right? So you might think there's this oil boom going on in North Dakota. A lot of jobs out in western North Dakota. Not many people live in western North Dakota, right? A lot of unemployed people in other parts of the country. And maybe those people just can't move to North Dakota for some reason. It's difficult to sell their house, maybe, or it's expensive to move, or they're going to miss their family if they move. And so maybe they're not moving out there. And people have suspected, and I'm going to say suspected because it turns out they suspected wrongly, that Americans were moving less than they used to. Right? So we like to think of America as this very mobile place where workers move around all the time. And there were some statistics put out by the Census Bureau that showed that suddenly in 2006, right around the time of the housing crisis, people started moving a lot less. And people looked at that and said, aha, people are not moving. It's the housing crisis. They can't move to those jobs. That's why there's all this unemployment. If only there hadn't been a housing crisis, it would be easy to sell your house. You might not be underwater on your mortgage. You'd just move to North Dakota and get a job. It turns out that the reason the rate of people moving that the Census Bureau calculated, the reason that rate dropped is not that people actually started moving less. It's that the Census Bureau changed its computer programs. So a co-author and I actually looked at what they were doing and learned that they changed the computer programs, and that's why that rate dropped. And when you correct for this, when you process the data with the same computer program the whole way through, you find that the migration rate did not suddenly drop at the time of the housing crisis. So there's actually no evidence that people were moving less as a result of the recession. People have been gradually moving less and less over many decades. People now are about half as likely to move between states as they were in the early 90s. So over a very long time, there's been a big change. But what our research found is that it has nothing to do with it being difficult to move. The reason people move less is actually that there's less reason to move. If you go back many years, labor markets around the country were extremely different. The kinds of jobs you could get and the wages you could get varied a lot around the country. So there was a good reason to move. You wanted to move to the place where you could get the job you wanted, where you could get paid well. Now, those differences are much smaller. So there's less reason to move. And so people move less. So it's not that moving is difficult, it's just that it's not needed. Right? So the evidence is that there's not a whole lot of geographic mismatch. Other economists have tried to measure that in other ways and also found that workers are not in the wrong places for the jobs. The other thing that can happen is that workers might not have the right skills for the jobs. Right? And some economists at the Federal Reserve Bank of New York have tried to very carefully calculate what skills are needed for jobs by looking at help wanted ads and match those up to the skills that workers have. And they found that about 1/3 of the increase in unemployment during the Great Recession, so about 1.5 percentage points of unemployment, could be explained by an increase in workers' skills not matching up with the skills that employers wanted. So some of the run-up in unemployment was possibly due to that increase in mismatch. Now the mystery is that this mismatch between workers' skills and the skills that employers wanted actually came down as the recession ended. So we're not quite sure whether this mismatch is a real thing that really workers didn't match up with the jobs, or whether this is a statistic that just always goes up and down with the unemployment rate and doesn't really tell us a lot about how well matched people are.
A simplified view of how an employer would decide to hire more people would be in at least in response to an increase in demand for their products and services, or in anticipation of a future increase in demand. Of course, vice versa too. They'd probably shed workers for the same reasons. Question is, how, in a simplified way, does Federal Reserve policy play into that decision making?
Great. So as you saw in the video, if you watched that, what monetary policy does is influence the general level of interest rates in the economy. Right? So if monetary policy is looser, interest rates in general are lower. And if monetary policy is less accommodative or tighter, interest rates in general are higher. So now think about a consumer or a business that's making some kind of a decision about spending money. So for instance, a family thinking about whether to buy a car. When interest rates are lower, it's more attractive to buy that car now. When interest rates are higher, it's more attractive to wait and buy that car later. Right? So that might be because they need a loan to buy the car. Right? And if they need a loan, when interest rates are low, the payment on the loan is going to be low, and so they want to go ahead and buy the car. If interest rates are high, they're going to wait because the payment is going to be high. Even if they got cash in the bank to buy the car, low interest rates will make them buy it soon because their cash isn't earning much interest in the bank. High interest rates, their cash in the bank is now collecting a lot of interest. They want to keep collecting that, so they'll wait and buy the car later. So when interest rates are lower, people tend to spend more money now. When interest rates are higher, they tend to defer that spending. It's the same thing for a business that's thinking about making some kind of investment. Building a new factory, buying equipment, even hiring workers can be viewed as an investment because you've got to get that person all trained up before they work. So when interest rates are low, households and businesses spend more money today. When interest rates are high, they wait and spend the money later. If people start spending money today, that's going to be that increase in demand that you're thinking of that would get an employer to hire people.
Does the Fed have any appetite to try to get better data from the Bureau of Labor Statistics? Their data hasn't been right since Truman beat Dewey in 1948. And you seem to be quite happy with having an ADP report on job creation come out at the beginning of a week saying it was X, and then have a significantly different number 5 days later from the Bureau of Labor Statistics, and then a month later when it's corrected, what was 210,000 jobs becomes 70,000 more or 70,000 less, you might as well not have any data, but you take it and you crunch it. I mean, I don't know whether the question of whether you are seeking a job, which is one of the baselines here, is an epistemological thing. How hard does somebody, will he take a job at 1 penny less than he earned the last job? Will he go more than 5 miles from his home? But I mean, the data that moves markets is so inaccurate that you might as well just have a dartboard. And I don't know whether it's too expensive to do it, but does the Fed seems to just blindly take this data and happily use your computers on it. So
this is really crucial to think about. How good are all these data I was showing you, right? If these data are no good, we shouldn't make decisions on them. We shouldn't judge the progress of the economy by them. So we want to know how good they are. And we take that very seriously. So an example of taking seriously the quality of the data is the research I mentioned on the Census Bureau's measurement of how many people were moving between states. Right, and the Census Bureau was saying this many people are moving, and then it changed in 2006, and people were thinking about making decisions based on that. And my co-author Greg Kaplan and I actually said, well, let's figure out exactly how they estimated that number, right? And we learned a lot about how they estimate that and about the computer programs that were involved, and discovered that the thing they were reporting was not an actual change. It was just a change in the computer program, right? So that's an example of the kind of research we do to ensure that we do have an accurate understanding of the data and that the data are the highest quality possible, right? But that said, it's very difficult in real time to produce perfect data, right? So what is the BLS doing? They're going out, and every month they're surveying tens of thousands of households and many, many businesses about they're asking these households, do you have a job? Are you looking for a job? Many other things. They're asking businesses how many workers you've got, many other things. And then they're trying, but now tens of thousands of households is lots of people, right? But it's very, very far from being the whole economy. So they've got to produce an estimate for the whole economy based on these samples. And all kinds of things can go wrong when you collect a sample, right? The people you survey could randomly turn out to be not representative of the country as a whole. Even if you do your best to pick a representative sample by randomly picking people, you might just get a bad draw and they might not be representative, right? Or it might be that some people refuse to answer the questions. And maybe the people who refuse to answer are different from the ones who do answer. And then you have to figure out how to adjust for that. So this is a very difficult problem. The only way to solve it would be to require every American every day to answer a whole bunch of questions from the Bureau of Labor Statistics, right? And if we actually made people do that, we'd have perfect data, but we'd also have a lot of really unhappy people, right? So that's not going to be a solution. So there's always a balance between how much data you want to collect and how costly that is, and the burden, not just the cost of the government, but the burdens it imposes on the people you collect the data from, and how high quality the data will be. But that's why we do research to understand the quality of the data and try to improve it. And we're very, very aware that any of the data we look at can be imperfect, that these numbers get revised, that they change over time. So no one ever looks at one number and says, that number is exactly right, and I'm going to make a decision based on that number. You're always thinking about each number you see in the context of all of these other numbers to try to get a sense of how right you think those numbers are.
One thing that bothers me about your whole discussion is that it is within a very limited context when in fact our economy today is a function of the global economy. You know, for example, these little statements come up like 2/3 of the U.S. Currency is held by people overseas. Well, if that's true, how do you control inflation in the United States? And, but, you know, I mean, you might want, if you can comment on that. And I did have another question I have to ask. You said, did you say building houses is the best indication for measuring economic growth? The amount of home builds per year? Just in the very opening, I think you said something like that.
Okay, so let me answer those two questions in reverse order. So I don't recall saying that building houses was the best indication for economic growth. I think someone had asked how population growth might affect the economy. And one thing I noted is if the population grew, more houses would need to be built, and that would help create jobs. That doesn't mean it's the best indication of economic growth, but that would be a factor. So I agree with your concern there. On inflation and currency held abroad, so I think the statistic that Toby mentioned was that 2/3 of US currency is held abroad. What that means is the actual paper money, 2/3 of it is abroad. But most money is not actually paper money. It's entries in bank accounts. It's electronic entries, right? So most of what is the US dollar is not actual paper money. It's entries in bank accounts, and by far most of that is within the United States, right? So the fact that there's a lot of paper money abroad does not have a huge influence on the Fed's ability to control inflation in the United States, because most of the money supply is really electronic.
Among the jobs that were lost during the latest recession, did we have a disproportionate amount of jobs being lost in some industries or not really? Thanks.
Certainly, there were huge job losses, obviously, in the construction industry when the housing sector slowed down. And on the other hand, in some industries like healthcare, there were relatively few job losses, right? So there were big shifts in which industries were strong and weak during the recession. Right? And that's one reason people looked for whether there was a mismatch between workers' skills and the available jobs, right? If the jobs are lost in construction and the jobs that are available are in healthcare, you might think someone who knows how to build a house might not know how to be a healthcare worker and might need to retrain. And that's why people studied how much mismatch there was and found that that was a factor in the rise of unemployment.
All right, I had a question about the Minnesota minimum wage going up soon here. In the next 5 to 10 years, do you think unemployment will change because of the minimum wage going up? And a couple things I have here is it might discourage workers back in the workforce, but also could discourage employers to hire more due to the high wages.
Yeah, the minimum wage has a few effects on the labor market. So the first effect you might think of is that a minimum wage law is a law that says it's illegal to hire someone and pay them less than a certain amount, right? So you'd think that could reduce the number of jobs, right? Because if a job is only worth $6 an hour to the employer and we say you can't pay people $6 an hour, that's illegal, then they just won't create that job, and so that would reduce the number of jobs, right? Now, on the other hand, if you raise the minimum wage, some workers will actually get a raise, right? Because employers have some bargaining power with their workers, right? So an employer who's bargaining with the worker about how much to pay them, often they can say to the worker, you know what, I don't have to pay you as much as you want because I know you're going to take this job even if I don't offer you a good wage. And if we raise the minimum wage, the employer will just have to pay that person more, but they won't actually eliminate the job. Now, what happens when that person gets a raise? They might go out and spend some of that money, and that would help create jobs. So there are two offsetting effects, and studies have found conflicting results about whether raising the minimum wage actually reduces or increases the number of jobs. So that's the number of jobs. Then we have the unemployment rate. The unemployment rate is how many people are trying to find a job and can't. So now we have to worry about labor force participation also. And as you said, changing the minimum wage might change the number of people who want to work, and so it could change labor force participation. So it's quite unclear exactly what effect it would have. Most studies have suggested that the kind of levels that are being talked about in Minnesota, these effects would be quite small, right? If we raised the minimum wage to $100 an hour, it's pretty clear what would happen, right? But at the levels that are being talked about in Minnesota, the studies have suggested that those effects would be pretty small.
Have you seen any early research about how the Affordable Care Act has influenced employment? I'm thinking you were talking about lock-in before, about geographic mobility. And one of the main goals was to loosen lock-in around health insurance. Is anybody researching that?
Yeah, people are researching that. I know of people who are researching it. What I don't know is what they're finding yet. It seems very soon to tell. Right? So that's partly because this is the first year it was implemented, and then it takes time to gather the data and analyze it. It's also partly because it takes employers a while to react to this change in the law. Right? So employers have to analyze, now the laws are different about healthcare. Now I have to think about whether I want to change the benefit package for my employees. Right? So it was recently announced that Walmart was going to make some changes in the benefits that they offer. Right? And I expect that over time, as the Affordable Care Act is in place for longer, there will be more and more thinking by families and businesses about how they want to change how they behave now that there's a very different law in place. But it will take a while for that all to sort out because people actually need time to make those decisions. So people are definitely working on that, but I haven't seen any answers yet.
Your unemployment measurements are from 25 to 54. You talked about the lower end of the range. What about 54 plus? How are they doing in the recovery?
Great question. So I showed a number of statistics. The unemployment rate I showed is for the whole country, right? And then for the employment population ratio, I showed both for everyone and for people 25 to 54 to try to adjust for retirements, right? So what we've seen two phenomena in recent years with older folks. One is that actually labor force participation has been higher than we would have expected in normal times, right? And that could be that people lost some wealth, their houses dropped in value, their retirement accounts dropped in value, and so they said, I need to work longer than I otherwise would have. Right? But the other thing is that there have been a large number of retirements, right? And so some other people might be saying, I lost my job. The survey taker comes, I think it's going to be tough to find another job. The survey taker comes around and says, are you employed? Are you unemployed? Or what are you? And they say, you know what? I'm retired, right? So there are these competing forces of some people finding it hard to find jobs and therefore retiring early, and other people saying, I lost a bunch of wealth, I need to work harder.
According to your unemployment rate by education, I see people with high school diploma or less, the unemployment rate is 8.4. China just surpassed the U.S. in GDP, and part of the GDP is the export, where we can work on increasing the employment in the U.S. Is the Federal Reserve doing anything to reverse that effect as far as policies to create more jobs here instead of importing goods that are hurting us in the long run?
Great questions. How international trade affects jobs here is pretty complicated, right? So for some workers, if you do a particular job here, and then a company figures out a way to do that same job in another country for less, that's going to be very bad for you. You'll be out of a job, right? But there are a couple other things that happen, right? One is, if that job can be done more efficiently in China, that frees up Americans to do things that Americans are more productive at. And so in the long run, that can make the United States more productive. In addition, if those goods can be made less expensively in China, that means everybody gets to pay less for them and prices will be lower, and that's a benefit to all consumers. So on the one hand, you have these benefits that are spread out across many people. On the other hand, you have some particular workers who suffer when their job moves overseas, right? Now, in general, most economists think that the net benefit of all of this is a positive because of increased productivity and lower prices, and that the important thing to do is make sure that workers who lose their jobs because of changes in international trade are well protected against that shock. For example, by having better training programs so that they can move to a new job that is still here. Right? Now, having better job training programs is really important, but it's also very far outside the Federal Reserve's mandate. Right? What the Federal Reserve does is we have a very blunt instrument. We use monetary policy to get the entire economy going faster or slower. That's all we can do. Right? So we can get the entire economy going faster or slower. If we get it going faster, there will be more jobs, but we're not really influencing what kind of jobs those are. Right? And we're not influencing what skills workers have in this country to do those jobs. In the long run, for American workers to be successful, they're going to need to have skills that are highly compensated on the world market. If the skills you have are ones that billions of people all over the world also have, you're going to face a lot of competition for a job because you're competing in a world market for jobs. Right? And it's going to be hard to have a high wage and a secure job. If you have skills that are very scarce, that the world really wants, then you'll be well paid, then your job will be secure. So in the long run, what American workers need are skills that will be highly rewarded, but that is not a policy that the Federal Reserve adjusts.
So I was wondering about how the regulation on banks affects the monetary policy, and a lot of the rates we've been buying a lot of bonds, we've been buying a lot of bonds to make money more available, but banks have to pay more to the employees and all of that to manage regulation.
Yeah, so there were very important changes in financial regulation after the financial crisis and the Dodd-Frank Act, right, which in essence require banks to be more careful than they used to be. Right? And that's a cost for them. It's a cost that Congress decided is one that should be paid, that's important to protect the economy as a whole, but it certainly could slow banks down or make it harder for them to make some loans. Right? So what that means is that in general there's going to be less lending going on than there would be if there was a less restrictive environment. And the Fed has to account for that in deciding how to set monetary policy. Right? So if the Fed said, we're going to do monetary policy the same way we did before there were those regulations, and hope for the same effects as we used to get, that might be a mistake because those regulations might change how the banks respond to the same policies. Right? And so the Fed has to constantly think through how do we need to adjust monetary policy now, given the regulations that are in place, given everything that's going on in the economy, which might be different from the past, to achieve the goals that we have now. And what we have to do now to achieve our goals might be different from what we used to do to achieve the same goals because of changes in the economy, either those kind of changes in regulation or anything else. It's not exactly how regulation affects rates in the past. It's much more about what loans get made, right? So there's been concern that the housing market is very good for people who can actually get a mortgage, right? But that it might be hard to get a mortgage. I think Ben Bernanke, the former chairman of the Fed, was quoted recently saying he applied for a mortgage and couldn't get one, right? And the reason was he doesn't really have a job. He's just going on a book speaking tour. And so the loan officer, it used to be the loan officer could say, well, I see that you're Ben Bernanke, you're a famous man, people pay you a lot of money to give speeches, I think you'll repay the loan. Now it's all got to be documented by 2 years of pay stubs. He doesn't have that. The computer that does the underwriting won't give him a loan, right? So these changes make it harder for people to get loans. And so you might look and say, well, mortgage rates are really low. That ought to make the economy boom, right? But if you only looked at the mortgage rate, what you'd be missing is there are a whole lot of people who can't get a loan anymore, who used to get a loan. So to decide what's the right way to adjust interest rates, we have to be aware of the fact that now there are people who can't get a loan who used to get a loan.
Prior to the recession, the average duration of unemployment was around 16 weeks, and after that we have seen 40 weeks, and it is still around 38, 39 weeks range. In your opinion, what factors explain this extended duration of unemployment?
Now, so not only are more people unemployed now than were before the recession, but when you're unemployed, you stay unemployed much longer. The biggest factor driving this is that once you become unemployed, it's much harder to find a job. Your probability of going back to being employed is lower than it used to be. Job finding rates are just lower. So imagine someone becomes unemployed. If they have a 50% chance of finding a job in any given week, then after the first week, half of the people who became unemployed are back at work. After the second week, 3/4 are back at work, and so on. And so the average duration of unemployment is going to be really short. If people have a low chance of finding a job, if you have only a 10% chance of finding a job, then after the first week, only 10% are back at work. After the second week, only 19% are back at work, and so on, and the duration of unemployment will be much longer. So what's been going on is for all people, and this is true, regardless of education, regardless of skills, regardless of characteristics, for all people, the probability of finding a job once you become unemployed is much higher now than it used to be. And that means that people stay unemployed much longer. Right now, why is it that it's harder to find a job? There's a number of factors that could be at work. There are things we've talked about. So it could be that people just don't have the right skills to match up anymore, right? And some economists have suggested that that's been a partial factor, right? In addition, it could be that unemployment insurance benefits are attractive. And so you say, I'd rather collect those benefits than go back to work. But most economists have estimated that those effects are small. Or it could just be that the economy is weak. There are no jobs to be found. If there are no jobs to be found, then it's going to take you a long time to find one.
So I had a question on your the U.S. unemployment rates by race and ethnicity, as well as the unemployment when you include U5 and U6. What does that look like when you lay those criteria on top of each other? So what does it look like for white, Hispanic, and African American, when you include U5, U6?
Off the top of my head, I'm not going to remember the exact numbers, but most of these move in parallel, right? So if you take a particular group, be it a particular education group or a particular race or a particular age group or what have you that has high unemployment, it's also going to have high part-time employment for economic reasons. It's also going to have high numbers of discouraged workers, right? And so groups that have high unemployment rates will also tend to have high U5 and U6.
I've been told by a couple of different people that active military personnel are considered unemployed and thus fall into the unemployment rate. And so my question is that true? And if it isn't true, are they considered employed, and what group do they fall into?
So I should check this to be triple sure, but all of these statistics should be about the civilian population. And so military personnel should not be getting counted in any way in these statistics. So I guess that's it. So thank you very much for all of your questions.